Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing fundamental analysis for novices, house price index. If you are not already doing so, we strongly recommend that you regularly check a reliable economic calendar each day to be forewarned about economic data releases from countries which might affect your open or planned trades. Economic data releases impact the market in various degrees, and you should always pay particular attention to the date of the event, the time, and most importantly, the likely impact it will have, which is usually in 3 degrees: low, medium, or high. Most calendars will also provide you with a previous data release in each category, the consensus or the expected data release as analyzed by economists and analysts who have come to an average consensus value, and the actual figure which is updated with the data upon release. Each country releases similar titled economic data into the market, mostly on an embargo basis. They do this in order to not give traders an advantage or to avoid market manipulation. Today we are going to be looking at house price index. Here we can see that there are 2 releases due for the 15th of June 2020. One has been collated by Rightmove Property website for the UK, where the numbers are a sample only and are reflected for the period of May and are devised by a month-on-month basis. The second is updated on a year-by-year basis. The impact level for this type of indicator is typically low and does not usually cause market volatility. So what is the house price index and how do you trade it? The house price index, or HPI as it's known, measures the price change in a value of residential houses. The data is typically released into the market on a month-by-month basis or updated on an annual basis. The data in all cases is calculated as a percentage figure from a specific start date. In most cases, the statistical method to calculate price swings is called a hedonic regression model. In the UK, the HPI is released by the Office for National Statistics. In the United States, the HPI is published by the US Federal Housing Finance Agency, where it measures those family homes that have been sold or refinanced in 363 metropolises. This is not to be confused with the FNC Residential Price Index as published by the FNC Incorporated, which records value in non-distressed home sales and is widely used by the mortgage sector as a tool to gauge price movements. The basic rule of thumb is that house prices which are falling in value are reflective of an economy which is struggling and whereby perhaps unemployment is high, wages are low, and the growth of the economy is slowing, stalled, or in recession. This would have a negative impact on the currency of a country, and thus you might find the value of a local currency falling in value in terms of exchange rates. On the flip side, a higher than expected HPI number might be reflective of an improving economy, in which case it's better for local currency, and you might find it increasing in value on exchange rates. Also, you should actually compare the HPI release number to the consensus value and the previous release, and remember that the markets do not like shocks. Deviations from the consensus and the previous releases can cause market instability. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.